Have you ever wondered how the wealthy invest money and they build intergenerational wealth? I've got a couple of key points to make today, particularly as we look out over the market and we begin to consider what's going on and what this means for investments. Stick with me till the end, and I'm going to let you know about some of the key points that I am looking at for myself and for my family. Many wealthy investors do have a lot of fixed income. Now, I know when you're starting out, this looks odd. Why would anyone put up with low interest rates? Why would anyone put up with bonds? Why make these investments that don't make a lot of money? And the key answer, I think, is twofold. Number one, for security. You know the money is there, you know it's not going to change in value very much, and you know you can access it when you need it. Now, there's two ways of accessing it. Number one, you can sell a bond. Sure, that's not always what you want to do, but you can sell those bonds. Number two, the other way of accessing money that you've got tied up or locked away in bonds can work really well with government bonds or investment grade bonds, corporate bonds. And this is to simply use them as collateral on a margin loan. That is essentially withdrawing money from your brokerage account, and the loan is being held with the bonds as collateral. And that gives you the flexibility and ability to use some of that money that's safe, that's tied up in this solid and strong asset. But I think that the second reason why many people with more wealth do like bonds, it's not that. It's simply because they do not like to lose money. Now, that's a very curious thing to say, and it's all very well when we think about making money and the excitement of making, 10, 20, or 30% returns in a year, or even in 6 months. But for many wealthy people, that's not the issue. For them, their key focus is often on protecting their wealth, on maintaining their wealth, on ensuring that there is a big, solid chunk of capital that they can pass on to their children or to their estate. It also helps when you have that security, that peace of mind, knowing that it's not going to change in value, knowing that it's going to be there for the long term. It helps you to sleep well at night. And this, my friends, is why I think many people with wealth, with income, will also invest quite a bit of their wealth in fixed income assets and bonds. Personally, I do have some corporate bonds in my personal portfolio. I also spend quite a bit of time looking for baby bonds. Now, baby bonds are lower down the capital stack. Now, what that essentially means is if the company runs into trouble, the bondholders will be paid back first, baby bondholders or subordinated notes will be paid out after that, and then any money left over will be going towards the common equity holders, and of course preferred stockholders before that. Now, what this means is with those baby bonds, I'm high up on the capital stack. Depending on the company, that can be actually quite high up as well if there's not a lot of other bonds being issued. Now, this has a couple of really important advantages because the value of those baby bonds does not tend to change very much. It will tend to be stable. Now, this will, of course, vary with the quality of the company that's issuing the baby bonds. If that company is running into trouble, then yes, the value of those baby bonds will suffer. But you know what? Generally, a good quality baby bond is going to hold that value, and that is a very powerful thing indeed. You can use concepts such as using the margin loan. So in other words, if you have, say, $10,000 invested in baby bonds, you could actually withdraw part of that money, say to fix your car or to take a holiday, and then repay it back into your account with your broker, and all of a sudden, bang, it looks good. Now, that's very similar to the idea of infinite banking, the infinite banking concept, IBC, that I've heard a lot about. It doesn't have quite the same leverage of using the whole life insurance, but it is another way that you can benefit from having those baby bonds. Now, I do like baby bonds for many reasons. I do like the way in which I can buy them, and often at a par value of 25, so I don't have to spend thousands of dollars to start a position like I do with corporate institutional grade bonds. Instead, with baby bonds, I can often pick them up at $25 per unit, and that's at par value. Now, if the price of the bond does decrease, this can be an added benefit because I'll be looking at those prices as they come down away from $25, and I know that on the maturity date, that company will be repaying me $25. So that means until that maturity date, I've got two sources of returns. I've got the coupon payments back to me, that income that the company is guaranteeing and will pay, and then the prices will go up and will converge at $25 on the maturity date. So I've got that capital appreciation on these baby bonds as well. Now, if you hear me talk about a yield to maturity, that is what I'm talking about. And the yield to maturity is a really important point because it's not just the coupons with baby bonds that can be important. It's also that capital appreciation over time. Now, of course, as I think about this and as I talk about this, baby bonds might be issued out with a maturity of 5 or 6 years in the future for many BDCs, or corporate investment grade bonds could have a maturity date of decades, 2050 or 2060 into the future. Now, that's not something I like. There's a whole load of other risks with those very long dates before the bonds mature. I tend to avoid those. I tend to focus on the bonds or baby bonds with nearer term maturity dates. It makes me feel a bit more comfortable with it. Now, another thing to note with baby bonds is the baby bonds that might be more or less secure than for other sources. So one of the key and important things to remember is, of course, that not all companies are equal. Now, some companies like BDCs or business development companies or closed-end funds are actually incorporated under a piece of legislation in the US which fixes or restricts the amount of leverage that they can take on. Now, what this means is they cannot just issue lots and lots of debt or lots and lots of these subordinated notes or baby bonds. They can't issue heaps. Now, as a result, it means when you think back to that capital stack, I'm further up that capital stack and they're more likely to be able to pay off those bondholders because they're not over leveraged. And that can be a fantastic feeling as an investor in that company. Now, another cool thing about baby bonds is the simple fact that when I invest in them, I've also got the opportunity to pick up some very nice coupon rates. So at the moment, there's a number of BDCs which do have good coupon rates of 8 to 9%. Now, you might say that does not sound like very much, but of course, this is not all of my income generating assets. This is just a portion. And in my wider portfolio, this is my middle tranche, which is for the long-term durability and stability of our overall portfolio as a hedge. So while the main stocks might be falling down because of a tough economic set of circumstances facing the market, I do have a part of my portfolio which is focused on as the market falls down, these stocks and these assets are going to appreciate in value, offsetting the losses from the main portion of the portfolio. Now, the third final part of my portfolio is my individual stocks, the satellites, if you will, my core and satellite stock portfolio. Now, these individual stocks, I'm buying them what I think is good value, and I am prepared to hold them for many years. Now, but I'm very much aware that I might need to sit on these for several years while my thesis plays out and while the prices recover to the point where I think they should be. And in the meantime, because they're dividend-paying stocks, they're also paying me those sweet dividends as they go. So what about you? Are baby bonds and other bonds part of your portfolio? And if not, why not? Let me know in the comments down below, and I'll see you on the next video.